In today's video, I'm looking at penny stocks trading around $2 right now for November 2025. I found three names with recent verifiable catalysts and fresh quarterly data that make each worth a quick look. OmniAb, OABI, at about $2, Valens Semiconductor, VLN, trading near $1.70, and Perfect Corp, PERF, roughly $1.80. I'll be direct and data-driven. If you like this format, hit like and subscribe so I keep delivering short, useful stock breakdowns. I'm not a financial advisor, and this is not financial advice, so always do your own due diligence. Starting with OmniAb, ticker OABI, this company builds proprietary antibody discovery platforms and licenses them to biopharma partners. The stock has recently been trading around $2 per share on its investor quote pages, and the company announced a license and services agreement with an ArrowMark/Viking-backed incubated company in mid-November, which is a commercial validation point for its discovery engines. OmniAb also released third-quarter financials in early November, showing operating progress and a strategy to monetize platform technology through partnerships and instrument sales. The firm previously completed a private placement that raised roughly $30 million earlier in 2025 to bolster its balance sheet and fund R&D, which reduces immediate dilution risk and supports near-term cash runway. Why OmniAb matters now? The recent license deal is a concrete commercial catalyst, and the company is converting R&D into payable contracts, which can materially change revenue cadence if follow-on programs or milestone payments occur. The risks are clear. Clinical discovery timelines are long, revenue visibility is limited. And biotech microcaps can be volatile, but the mix of a commercial agreement plus a strengthened cash position is what puts OABI on a watch list for traders focused on discovery platform stories. Moving naturally to Valens Semiconductor, ticker VLN. This is a chip IP and semiconductor company focused on high-speed connectivity solutions for automotive and cross-industry applications. Valens reported third-quarter 2025 revenue of $17.3 million, beating guidance and marking sequential growth, and management highlighted improving gross margins and expanding cross-industry revenue contributions. Valens has been sponsoring wins in automotive infotainment and also expanding into other connectivity segments, where its chipsets are used for long-reach, high-bandwidth links, which is a durable industry tailwind as vehicles and data centers demand higher throughput. The company announced leadership changes in November, including a new CEO appointment, which can be a double-edged sword. Fresh leadership often brings renewed commercial focus, but also creates short-term execution risk while transitions settle. From a financial lens, Valens' Q3 beat and sixth straight quarter of revenue growth is meaningful for a company at this price band, because steady top-line increases can drive margin leverage and reduce the perception of speculative risk. Valens' gross margin printed north of 60% in the quarter, and the firm reiterated product traction outside automotive, which supports a narrative of diversified demand rather than a single end-market bet. Last of the trio is Perfect Corp, ticker PERF, a provider of AI and AR-powered beauty and retail tech solutions, including mobile apps and licensing to beauty brands. Perfect reported Q3 results showing revenue around $16 to $18 million for the quarter in the late October release and achieved operating profitability on a GAAP basis for the period, marking an operational inflection after a prior stretch of investment. Perfect's model is subscription and licensing heavy, giving it recurring revenue attributes and relatively high gross margins in its cloud AR business. Year-to-date revenue for the 9 months through September was reported at roughly $51 million, and management cited continued growth in AI/AR cloud solutions, which is the core commercial engine. The stock has been trading near $1.80 on investor quotation pages, and the combination of steady revenue, improved profitability, and a clear product monetization pathway is why some traders are watching PERF for additional ARR acceleration or margin improvement in upcoming updates. For each of these names, the immediate opportunity is short-term catalysts plus recent operational evidence. OmniAb's licensing agreement, an earlier private placement, Valens' Q3 revenue beat and product wins, and Perfect's move to operating profitability and recurring revenue growth. The shared risks are also obvious: small cap volatility, dependence on a handful of partners or customers, and the general sensitivity of penny stocks to liquidity and sentiment swings. How I would approach these if trading: size positions smaller than core holdings, set clear stop losses tied to volatility rather than arbitrary percentages, watch volume spikes for confirmation of institutional interest, and focus on measurable milestones for OmniAb that could be milestone payments or additional licensing deals. For Valens, continued sequential revenue growth or design wins announced by OEMs, and for Perfect, incremental ARR and margin expansion in quarterly releases. In short, OmniAb gives a biotech platform story with a new license and a bolstered cash position. Valens offers a semiconductor revenue growth story with improving margins and CEO-level changes to monitor, and Perfect Corp shows an AI/AR SaaS-like ramp that recently moved to operating profitability. All three trade around $2 and have recent November quarter updates that matter to short-term traders and risk-tolerant investors. A disciplined timeline. Watch the next 30 to 90 days for follow-up press releases and earnings commentary that confirm the catalysts described above. Monitor volume and option activity for early signs of institutional accumulation, and track insider transactions or large block trades as potential validation. For trading, consider a 3 to 6 month horizon for corporate developments to materialize. And size speculative positions small, roughly 1 to 3% of portfolio value, so you avoid concentration risk and rebalance accordingly. What do you think, which of these three deserves the most attention in your portfolio or watch list? Let me know in the comments below. I'm not a financial advisor, and this is not financial advice, so always do your own due diligence. If you found the breakdown useful, please like the video and subscribe for more data-focused penny stock analysis.